Hello and welcome. You're watching All About Your Company here on ET Now. I am Harsh Saita and today we're going to be talking about KEI Industries in terms of its play within the wires and cable space. It has around an 8% market share in the wires and cable space, or rather near 9%, and it continues to grow, and that's the aspiration. In fact, when you're looking at it from the bottom of this year, if you pull up the year-to-date chart in front of you, and what you'll see is from the bottom, in somewhere in around April, the stock has given a return of 76% from that point till now. So if you've been able to understand the company and get a good grip of it, you've probably been able to make those returns. But let's quickly talk about what I want to know with regard to KEI Industries. First off, they've guided for a 15% volume growth. I'm trying to understand how comfortable they are with that, because you've got plenty of players, there's increased competition, and there's also another major couple of players likely to enter the space in the form of an Ultratech, in the form of an Adani Group. And when such large players enter, you could see some bit of disruption and some bit of that market share tapering off. I want to understand what gives the management the confidence to guide for this growth and whether they can continue to increase their market share, because that's the only way in which growth can come through. So that's point number one. Second, immediate margin levers. That's the second piece I'd want to know about. Now, in terms of why do I call it immediate margin levers, they've just booted the Sanand plant, and Sanand is likely to have a full capacity of 6,000 crore in terms of top line contribution to KEI Industries by FY28, but half of that is already on stream, which means that there is some bit of a lever with regard to margin uptick. The last time they spoke to us, which wasn't too far or long back, they said that a 1 to 1.5% increase in margins is likely by FY28. But how much of that comes immediately is what I'd want to try and understand better. He said it won't happen, but I will again try to push that question through. The third one is demand strong enough, because you've got this large capacity coming on stream. Now, Ultratech and the Adani Group, still some time away with regard to capacity coming on stream. But for the moment, even the quantum of capex that's being done by KEI, 3,000 crore of top line likely annualized already on stream, is demand strong enough to be able to absorb that kind of capacity which they are putting on. The fourth piece is with regard to competition comfort. It's not very easy when you have the kind of names coming in. We spoke about how market share defending is important, and this is a little bit more of the same point. Point number 5 is FY28. I want to understand the breakup. How do they visualize? They're going to be at roughly 17,000 crore in terms of top line versus the 10,000 odd crore which they do today. So how does export versus domestic work? Because export margins will likely be better. And how is that margin split currently looking at? Mind you, today they do only 16% of their top line through exports, and therefore, they've suggested that it will be 18% by FY27. So therefore, I'd want to know by FY28 where will they be, and are they seeing a larger opportunity in export given the kind of competition that is coming through on the domestic front. The last piece is capex beyond Sanand, because you've got visibility till FY28 with regard to top line. What beyond that? You want a company like this to continue to grow, and therefore, for investors, it will be important to understand whether and how management sees this play out. But of course, we'll start by talking about the company and what the company exactly does. Some of it already given to you, but it's been established in 1968. It's one of the top 3 organized players in the cables and wire space in India. It has a diversified product mix with regard to cables and wires. It has 8 manufacturing plants across Rajasthan as well as the Union Territory of Dadra and Nagar Haveli. 2,000 plus institutional customers is what it caters to, and it also does retail, which is B2C, and it does that through 2,100 dealers and distributors. Let's talk about the products. It does low tension power cables, which is 40% of the business. House and winding wires is around 33%. High tension cables is around 15%. And then you have some of the other smaller products which comprise around 10%. So that's the broad brush breakup with regard to the top line. Now let's talk about the channel-wise sales which play through. 53% of their sales is retail, so very positive in that sense. 31% is institutional and 16% currently is exports. We spoke about that export mix, and we'll see how this mix evolves and how the margins in each of these segments are like, because it will give us a pulse of what lies ahead in terms of margins as well. In terms of order book, it's less important, but broadly, that's the nature of the order book. And let's also talk about the annual trend with regard to the order book. Again, less relevant, but nonetheless, that's the annual trend. Let's talk about the top 10 customers. And there's been a consistent taper down. Now, this becomes important because there's been a consistent taper down of the top 10 customers. Currently stands at just about 13%. So that's a positive. Export sales have trended upwards from 10% to now 16%. The guidance is to get to 18 by FY28. Retail as a percentage of sales has gone up, which has also aided margins, and you can see that also on your screen. In terms of the presence, it's pretty much pan-India, but North dominated. 40% is North, West is around 25, South and East are the balance. So that's broadly the way in which it's set up. In terms of capacity utilization today, you've got cables, which is around 78% in terms of capacity utilization, but was 90%. Communication cables is around 46%. Home wires is around 65%, and stainless steel wires around 85%. So that's the broad brush breakup with regard to the capacity utilization as well. But let's talk about the metrics, as we always do. We'll start off with the profit and loss account. And when you look at the last 3-year CAGR on the P&L, it's around 19% on the top line, 19% on EBITDA as well. They do nearly 1,000 crore of EBITDA every year at the end of FY25 at least. And what you're seeing in terms of profitability as well is around a 23% compounding, 3-year compounding in terms of profit after tax. Let's also talk about the H1 performance, which has been very strong. 22% on the top line, 19% on EBITDA, and 31% on your net profit. When you're looking at the margins itself, the margin trajectory has been very, very stable. So good growth with margin stability, as you can see, and therefore a thumbs up on both margins as well as on P&L. Let's talk about the balance sheet now. And in terms of the book value is around 6,100 crore. They've done around a 2,000 crore fundraise within this. So within this, they've done a 2,000 crore fundraise in FY25, which is exactly a year ago. The market cap of the company is 40,000 crore plus, so it trades at nearly 7 times price to book. In terms of the borrowing, it's very, very low. I mean, it is sub 200 crore in terms of borrowing, so we won't talk about that at all. Cash in bank, though, is solid. Given the amount of free cash flow it generates, which is nearly, the operating cash flow is nearly 700 odd crore annually. And then on top of that, you've also got a large cash balance because of the fundraise that they did last year. So you've got both of those in combination, which basically is keeping that amount of surplus cash on the balance sheet quite large. And a lot of that is because of the capex that they've done on the Sanand plant. We'll talk a little bit about that. But let's go straight to the cash flow. In terms of the cash flow, it's negative 32 crore because they've utilized the excess cash available due to the fundraise to pay off some of their payables. And they've done that early. So their payable days have gone down substantially as a result of this. But that's a one-off. That's because they were sitting on cash. Otherwise, you'll see that the cash flow to EBITDA has largely been 70% odd. Nothing to be concerned about. We've given it a neutral only because it's 70% and you want your working capital days to improve. But outside of that, it's fairly normal industry practice. And therefore, there is no concern whatsoever. Want to reiterate that with regard to the cash flow. The net cash flow, less relevant number, but nonetheless, those are the numbers for you out there. Let's talk about ROCE, and within the ROCE ratios, you'll see extremely solid numbers, 20% plus consistently, a clear thumbs up here. Very few companies being able to do that kind of ROCE. KEI is one of them, very low on borrowing, and they continue to do that. Now, the question, of course, is can this sustain? Well, their aspiration is to get to 25% as soon as possible. So we'll try and get a sense as to how quickly can they get there. Let's talk about shareholding now. 35% promoter held. So there is lesser skin in the game from a promoter standpoint, but nonetheless, You're seeing very strong interest from FIs and DIs, as you can see on your screen, and the public also holds around 12% in terms of a stake in KEI Industries. We've given this a neutral only from a perspective that the promoters own less than 50, which is typically what we do here, to say that there is a slightly lesser skin in the game. But nonetheless, very, very active set of promoters out there. Let's talk about valuations now. Does it trade cheap? Not really. 42 times is their 1 year forward price to earnings ratio. 32 times is the 5-year average price to earnings ratio. You've seen a very strong rally on the stock already from this year itself, but also over the last 5 years. It's been a 10-bagger. So what we're saying is, of course, the price to earnings is elevated. It's trading at much more than what you're seeing on your screen, because this is the 1 year forward price to earnings. In fact, it trades at 40 times FY27 PE. So that's something you want to keep your eye out on. And that will reflect also with how analysts are viewing this one. When you're looking at how analysts are viewing it, 17 buy calls, 4 hold, 1 sell, with just a 3% upside. So when you have that kind of valuation, where we've seen valuations run up, there is limited upside, is what even analysts seem to be indicating. But let's go across. We have Anil Gupta, who's the Chairman Managing Director at KEI Industries, who's here with us to talk to us about exactly what the next 3 to 4 years could hold in this very, very interesting and fast evolving space. Mr. Gupta, it's always great chatting with you. Let me first start off by trying to understand. You've guided for a 15% volume growth. There is obviously competition coming through. What gives you the confidence? And I'm sure you've had plenty of people asking you this question, but give our viewers a perspective. What gives you the confidence that you will be able to hold on to your market share or even increase it, because that's your aspiration?
Yeah, so good afternoon. Thank you very much for calling me on this show. Why I am confident about this is that our very strong marketing network across India, and now even gradually we are building that network world over. Secondly, our brand acceptance in India, our approvals with the large cable customers and in India, and now gaining ground in overseas markets also. This gives me the confidence that we will be able to sustain this 15% volume growth and our market share in India. We are consistently working on adding more international markets and more products approvals in overseas countries, so that we, even in US also, we have taken a lot of approvals, but at the moment that sale is not happening because of the tariffs. But sooner or later, whenever these tariffs goes away, then we will definitely be able to restart that market. But other than US, our other markets, especially in Middle East, Europe and Australia, and as well as Africa, that is building up and going strong. That is why we are confident that we will be able to improve our exports to 18 to 20% of our turnover in next one to 2 years.
So 1 to 2 years, your export turnover goes from 16% of revenue at the end of FY25 to around 18 to 20%. What does only that do to your margins is what I'm trying to understand, because my guess is that export margins are likely significantly better than domestic, right?
Right. You are right. But since they are not significant enough to improve the overall margin, so as the export goes up, and also we are targeting a lot of economies of scale because of rising production levels in our factories, and our new Sanand facility, getting into commercial production. So the FY27 should see a bit of economies of scale and improvement in margins. At the moment, we are consistently working on stabilizing the Sanand plant and also obtaining plant-specific approvals from the customers, so that we could start a significant sale from that facility.
How long does that take, sir? Because there are multiple questions now that I have on that one answer itself. How long do those approvals take? And give us some color around what's the nature of the approval or the process.
We have to go for a lot of type test on the cables produced in that plant, and factory visits by the customers so that they approve that facility. So I think within India, with our existing customers, we should be able to complete that process maximum within 3 to 6 months. And also similar is the timeline we require for exports customers also. But nevertheless, the production and sale has started, and it will continue to grow month after month. Reason is that there are a lot of markets which do not require plant specific approvals, so that sale can start, has already started from that plant, and it will continue to grow.
Understood, Mr. Gupta. And would you say that, so Sanand Phase 1 has a capacity of around 3,000 crore in terms of top line. Would you say that the entire 3,000 crore will, that you'll be able to absorb the full 3,000 crore in FY27 itself, or will capacity ramp up gradually? I'm trying to get a sense of that.
I think normally capacity ramp up gradually. So a lot of it, I think around 50 to 60% will definitely, or even more than that, you will see in FY27, because we have 3 months of FY26 also as well with us. So there will be a significant contribution from new facility to our sales.
And is there enough appetite in terms of demand for your products to be able to absorb that kind of traction or volume that you're going to be generating in FY27, because it's a large amount?
Yeah, because demand in India is growing, and similarly, we have a lot of unsatisfied demand from our export customers also, whom if we commit shorter delivery periods, those orders will mature. Sometimes due to longer delivery period, because of the availability of capacity, a lot of orders do not come, because if we offer them 10 weeks or 12 weeks ex factory, then that means we are talking of 4 to 5 months at destination, which works negative.
I understand. And if I were to just try and understand the numbers better, you said FY27 margins will likely improve. By how much, sir?
See, on a conservative basis, I can say we can expect 0.5%, or on a broader basis, I think up to 1% it can improve. So
would your margins therefore be in around the 11 to 11.5% range, FY27? Is that something one can pencil in?
Yeah. Yes.
Okay. And sir, FY28, you've said that, or rather, if you work full power with regard to Sanand, likely you'll reach a top line or potential top line of 17,000 crore. I won't try to push you to give me a number on that, but just if I were to just add the 6,000 crore top line of Sanand, you'll likely reach a 17,000 crore top line. I'm trying to understand how confident are you with the competition coming in to be able to achieve that. And I'll tell you why. Because you've got two very big players who are known to be industry disruptors who are going to come in. So that's where the possible risk lies. And what therefore is your take to your shareholders as a result of that?
I don't see any challenge in, we have given a guidance of our projected growth to around by 20% year after year for next 3 to 4 years. And I don't see any challenge coming from these two new players which you are talking about, because both of them are, I think, coming up in house wire, so which will be limited to the domestic market. And the brand building also needs time, and apart from that, markets are also growing, demand is also growing. I can't say anything much about it, but let them come. We'll see the challenge, how we have to face it. At the moment, it is difficult to predict that what will be the shape of the things once the two new players comes up.
I appreciate the candid nature of your response, sir. Mr. Gupta, also the other piece is, and we've spoken about this in the past, we've had this conversation, but let me also, for the sake of completeness, try and get this out of the way. Copper prices going up doesn't impact you. There's a complete pass-through on all your contracts on 100% of your sale.
Yes, it is definitely 100% pass through on our sales, because whatever orders we have in hand, either we have inventory with us, or we have price variation clause in the order, or we have material in the pipeline. So we have never lost on account of metal pricing. Although quarter on quarter, some variation in the EBITDA by quarter percent to 0.35% can happen on quarter to quarter. But if overall in the full year, we have never seen any impact.
Point taken. So you'll be at maybe 17,000 crore by FY28 in terms of top line. So what thereafter? Because you'll need to set up fresh capacity. You're very near, max capacity utilization. What next thereafter? What's in the pipeline in terms of capex?
We are already, planning new capex in our Bhiwadi location. We already have available. We have already procured land also for that, and maybe we start the construction over there next year. Similarly, we are also planning further expansion in Gujarat, for which we already have land bank with us. So I think that planning will be on board by early next year, by April, and we'll have clarity that what will be the capex plan, and which will come in next 1.5 to 2 years on board.
Okay. So with regard to the split, so at 17,000 crore of top line in FY28, if one were to assume you're at full capacity, what would the split roughly be? You're saying aspiration would be 20% exports. How much would be retail and how much would be B2B in India?
Retail will definitely constitute around 55% of the sales. And if we assume 20% exports, then we are talking of around 25% to 25 to 30% by B2B.
If the US tariff issue were to get resolved, is there an upside potential to the export percentage or the export mix? And if you can, sir, give us a sense of what the export margins look like.
I can't predict about the US tariffs, but definitely it will help us in improving our exports. And so far as margin, I've already clarified that we can definitely expect 1% higher EBITDA if exports have to go up and the economies of scale together.
Sure. So I'm just trying to push you and trying to understand the export margin number. But I understand that you're not in a position to give me that. Okay. Thank you so much, sir, for giving us that perspective. And it's a pleasure speaking with you.
Thank you. Thank you for inviting me.
All right, and viewers, that gives you a very good pulse of what's playing out within the cables and wire space. KEI, of course, completely insulated from any kind of copper price fluctuation. That's what Mr. Gupta said. He also was very, very clear in suggesting that he will do a likely 18 to 20% export number of total top line in the next 1 to 2 years itself. Maybe by FY28 it goes higher. And that will also incrementally add margins. Mind you, margins, he has already guided that by FY28 will go up by 1 to 1.5% from here. But he guided that FY27 will be 0.5 to 1% better from here itself. So, I mean, running the numbers, therefore, that's for viewers to do. We're completely out of time on this edition of AAYC. Thank you so much for joining.